Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at a couple really beaten down growth-focused tech stocks to consider buying right now amid the volatility as we head into 2022. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into the two really beaten down growth-focused tech stocks, I want to take a look at the broader market and some fundamentals of what's going on to give a better sense of why it might be a good time to consider buying some of these beaten down names. So the S&P 500 has climbed roughly 23% in the last year, and the NASDAQ is up about 17%. So with the recent selling, the benchmark index is currently hovering around 4% below its recent records, with the tech-heavy index now about 7% off the pace. We then saw, including these declines today. So the Dow was down about 1.8%, with the S&P 5 down. Actually, they're all down about 1.8% the last time I looked on Monday morning. And the recent drops Monday morning are appearing to be on the back of some COVID fears, once again, with some countries imposing stricter lockdowns amid the spread ahead of the holiday season. So we saw the Netherlands on Sunday reimpose a lockdown with all non-essential shops, bars, and restaurants closed until mid-January. We then saw Irish Prime Minister announce some new restrictions, and then reportedly President Biden is planning to deliver some updates on Tuesday with some plans of what's going to happen in the U.S. with cases rising. That said, it's unclear what will happen, but it does seem that the possibility of a broad-based lockdown once again in the United States, it's not necessarily the political will for that, so it might not be in the cards. In the recent wave of selling really has also fallen on the back of broader COVID fears and then what's going on with the Fed. So all this started back on Black Friday. We could see selling continue into the early days of 2022 as well, amid the constant fears of what's going on with COVID. But if we look at what's going on with the Fed, we noticed that they said last week that they're planning to end their tapering by March, cutting its timetable from June as it winds down that stimulus-focused bond purchasing. Wall Street has also focused more on Jay Powell and the Fed's updated outlook for interest rate hikes amid 40-year high inflation. So the Fed expects they will start to lift rates in the second half of 2022. So nothing is expected until the back half of next year, with then 3 hikes projected next year and 3 hikes projected in 2023. So the guidance gives Powell and his peers more time to see how the economy is performing, with hikes really only likely once there's a stronger feeling the pandemic is fully behind us, or if rising prices get far too out of control and they are forced to step in and raise rates. It's also worth remembering that the two most important factors that drive stock prices over the long haul, which are earnings and interest rates, both continue to flash pretty bullish signals. So for instance, even if the Fed start to lift its core rate sooner than projected, even in the early days of 2022, it will take a pretty long time to get back to levels that would make stocks look unattractive. The 10-year U.S. Treasury has rarely and barely moved above 3% since the financial crisis, and if rates were pushed back up to the 4 to 5% levels of the early 2000s or the pre-2000s, so the first decade of the 2000s, U.S. debt servicing costs would be far more daunting. So there's less incentive to get up to those levels for the U.S. government. Plus, U.S. bonds, even at their current levels, with the 10-year at about 1.4%, are far more appealing compared to the near zero or even negative rates in major economies such as Germany and Japan. So there will continue to be that demand globally for U.S. Treasury bonds, which will keep down the yields. And the S&P 500 earnings and margin outlook for 2022 and 2023 remain historically impressive despite some rising prices, and tough to compare against periods this year. So circling back to the market, the strength and the massive impact of mega cap technology stocks has covered up the fact that many one-time COVID high flyers and big growth names have already given up almost a year worth of gains in many cases and are trading at new 52-week lows heading into the new year. So with this in mind, it appears that could be a time to get in on some of these growth-focused names for 2022 and beyond, since Wall Street has really already chopped many of these growth names down and recalibrated their valuations, despite the fact that the S&P 500 and the NASDAQ are not way, way, way off their highs, and they're certainly nowhere close to 52-week lows. So the strength of the big tech, as we mentioned, Apple and Microsoft and others, has helped cloud the fact that Wall Street's already really done their job in recalibrating a lot of these huge growth names that certainly got pretty overheated in the early days of 2021 and peaking maybe many of them in the February, March levels, and then early or late August of this year. So since then, things have really changed, and a lot of these stocks are looking to be maybe worth scooping up at the moment. And the first one we're going to take a look at is Snap Inc., which trades in the ticker SNAP. So Snap, the stock has tumbled, or it did tumble over 20% in the blink of an eye after it warned investors on its Q3 earnings call in October. So this was on October 21st, to be specific, that changes to Apple's privacy policies were making it more difficult for advertisers to, quote, measure and manage their ad campaigns for iOS. The news sent waves through the broader digital ad world, including Facebook, which has been publicly fighting with the iPhone maker since its announcement last year. Snap and its Snapchat app are fueled by digital advertising, and the firm is actively working on new ways to help its clients better track consumer engagement and more, including additional first-party tools. Wall Street had clearly discounted the impact of Apple's new opt-in focused app tracking, discounted what impact it would have on mobile-based advertising market, which is a huge market. So Snap's user base still is growing within key demographics that are hard to reach anywhere but their smartphones. So this backdrop really does provide Snap with plenty of long-term growth runway, because advertisers have to try to reach younger consumers as they disconnect almost completely from legacy media. So even with the changes in Apple's policies, which impact all iOS apps, it doesn't mean advertisers and marketers are just simply going to stop spending and not try to reach anybody on an iPhone or anything like that. So with this backdrop, Snap grew its daily active users by 23% last quarter to 306 million, and it boasts that it reaches more than 500 million people, including 75% of 13 to 34-year-olds in the United States, Canada, France, the UK, Australia, and the Netherlands. So yeah, it reached daily active users of 306 million. So when you hear that 500 million figure, that means monthly active users included as well. So Snap has attracted these highly sought after consumers by continually enhancing its social media app that the company really became famous for initially, those disappearing photos and videos. Snapchat is now really full of video content and shows, from social media stars to big-time Hollywood celebrities like Kevin Hart and others. And then we also know that big, huge brands like the NFL and countless others are also really prominent on Snapchat. Its Discover page has gained traction, and it's been in the booming mobile video game market for over 2 years. The company also constantly releases various augmented reality offerings, and it launched its Spotlight feature late last year that aims to challenge TikTok, which is growing rapidly as well. So Snap's Q3 revenue still climbed 57% to over $1 billion, and its adjusted earnings soared to easily top our estimates. So with this in mind, Zacks estimates currently call for its 2021 revenue to surge 61% to $4 billion, with FY 2022 projected to climb another 40% to about $5.7 billion. This year will represent its best growth as a public company, and then follow 3 straight years between 43 to 46% top-line expansion. Snap is also projected to swing from an adjusted loss of 6 cents per share last year to positive 35 cents per share this year, and then jump another 55% higher in 2022 to 54 cents per share. With that said, the digital entertainment app's revenue and earnings per share outlook remains really impressive overall, as we just noticed. But what is worth pointing out is that its FY 2022 EPS figure, so that 54 cents level, is down way below what it was before it released its Q3 results. So that could be the big reason for that huge drop. But Wall Street's already hammered the stock, and people are recalibrating their expectations as well. And we should also note that the company has destroyed our bottom line outlooks by an average of 230% in the trailing 4 quarters. So despite that figure going down in terms of the broader consensus, it could easily outpace that over the long haul in 2022, given its beats over the last year. Snap currently lands a Zacks number 3 hold and 23 brokerage recommendations. Out of the 23 that we have, there are 18 strong buys with 2 more buys, and the rest coming in at holds. So nothing below a hold, so no sells or strong sells in terms of all the brokerage recommendations that we have. With this in mind, Snap shares have tumbled nearly 50% from its September records. So they're down about 47% to be exact, and currently hover right near their 52-week lows at around $44 a share, which also might be just a more attractive price point in general for some people who don't want to necessarily be looking for stocks that are trading in the hundreds or 200s or anything like that. The move has also sent the stock well below its 50 and 200-day moving averages, and it's currently hovering right near oversold RSI levels at 33. And despite this broad tumble, Snap is still up 185% in the past 2 years, and it's now trading right around where it was early last fall at, as we mentioned, around $44 a share. And this is right after it went on a massive post Q3 release run last year in 2020. So as we mentioned at the top, a lot of these stocks have erased a year's worth of gains relatively quickly and are now trading at much more reasonable levels. The recent fall has the stock trading at year-long lows in terms of valuation as well. So at 13 times forward 12-month sales, which is well below its highs of 27. It got up to 27 times forward 12-month sales earlier this year. And it's actually below its 2-year median as well. It's so valuation looks much more enticing as well. We should also note that the current Zacks consensus price target of about $76 per share represents 70% upside to its current levels. So many might want to consider Snap as a longer term investment if you have, say, an investment horizon of at least the next year plus, just given how much it's been hammered. Obviously, there's still some uncertainty, but the two seemingly unstoppable trends of digital advertising and smartphone addiction are going to be places you think about investing, even if Apple's new privacy policies make it harder to track users. Once again, advertisers have to reach people somewhere, and they're not just going to give up completely, and everyone's on their smartphones, and Snapchat is still a place where lots of young people are spending a lot of their time, so advertisers are going to be continuing to try to reach them there. So certainly worth considering Snap for 2022 and beyond, given how far it's been beaten down. And then another name that fits right into this category is Roku, which trades under the ticker ROKU. So just like Snap, it trades under its name. Wall Street continued to sell Roku following its Q3 earnings release in early November as part of a longer and larger decline from its summer records. The streaming TV provider offered lower than projected revenue guidance for the current holiday quarter and posted lower account growth in Q3. Roku management pointed out to ongoing supply chain setbacks that were disrupting connected TV sales in the U.S. Roku pulled in 1.3 million new active accounts. Last quarter, Wall Street was calling for about 1.7, and last quarter, it lifted its total active users to about 56.4 million overall. And executives said they expect the setbacks to remain in 2022, with the overall U.S. TV sales in Q3 well below pre-COVID-19 levels. So just the supply chain setbacks are really hurting the broader connected TV sales. So near-term setbacks aside, it still posted blowout quarter results with adjusted earnings up from 9 cents per share all the way up to 48 cents per share, which crushed our estimate. It just blew it away. Meanwhile, its revenue climbed 51%. The firm is also due for a comeback, considering that its player space, which includes the streaming TV devices and smart TV OS, which is what's being impacted by the supply chain setbacks, accounts for far less of its business these days than it used to. Roku now makes most of its money from its booming digital advertising unit that enables companies to buy targeted ads to promote their streaming movies, shows, platforms, and more. In fact, its ad-heavy platform revenue soared 82% in Q3 to account for over 85% of total revenue, while its player segment fell 26% last quarter. So that just shows I was able to grow despite all of these setbacks in the player segment, which is going to continue to be a setback, at least in the near term. Roku ramped up spending to roll out more content, including original programming, which it has a lot more these days than ever before. It's also improved its own ad tech, and it's expanding its international reach far outside of the US and Canada. And in terms of ad dollars, people are still pouring money into streaming, and Roku's not being impacted really by Apple's privacy moves. Zacks estimates call for Roku's FY 2021 revenue to surge about 60% to $2.8 billion, and its sales are then set to climb another 40% higher in 2022, all the way up to about $3.9 billion, so adding another billion next year to the top line. And this would extend its streak of roughly 40 to 60% sales growth to 5 straight years. So just really, really impressive growth for this streaming TV player company that's now heavily based on growing its digital ad dollars, which is going to be a huge booming market as people pay to avoid ads on Netflix and Apple Plus and Disney Plus and everywhere. And everyone's cutting the cord, so Roku stands to benefit from all of this. So with that in mind, it's projected to swing from an adjusted loss of 14 cents per share last year all the way up to positive $1.55 per share this year. We should note that, like Snap, its consensus 2022 EPS estimate has slipped since where it was before the release, with that margin crunch in the players business and other headwinds, but it's improved actually since then. So it also grabs a Zacks number 3 hold at the moment, and like Snap, it's consistently blown away our bottom line estimates. And despite that post-earnings drop and the broader pullback from the highs, Wall Street remains rather bullish on the stock, with 17 of the 22 brokerage recommendations that Zacks has coming in at strong buys, with only 2 below a hold. So overall, as we said, Roku shares have fallen about 50% since late July, and it's popped back a bit recently. It's also still up 750% in the last 3 years. And Roku at the moment is trading at about 8.2 times forward 12-month sales, which is right at its lows, or right near its lows, and well below its median and well below its highs of 24 times forward 12-month sales over the last year. So overall, the valuation is just far stronger, and at $395 a share, which is the Zacks consensus price target, that marks 70% upside from its closing levels at the moment. And we should note, in terms of some other possible setbacks, the streaming company did fall last week after reports came out that Universal Electronics announced that the International Trade Commission had sided with it in a case against Roku, and hit Roku with a patent infringement ruling that could potentially ban some of its products from being imported. That said, Roku told various outlets that it does not anticipate any disruptions to its ability to import their products. So since then, the stock has bounced back. So that could have just been another chance to buy it. That saw it fall below oversold RSI levels, where it's now slightly above those oversold levels. In longer term, Wall Street's still really high in it, and it could be a good time to consider buying this growth-focused play on streaming and digital advertising, which are two really unstoppable forces. So both Roku and Snap look to be worth considering for 2022, just how far they've been beaten down at levels, 52-week lows, with their current price targets well above these levels, both about 70% upside to those levels we're talking about right now. So even if there's some more near-term selling to end 2021 and in the early days of 2022 amid some COVID uncertainty, both Roku and Snap look to be worth considering at the moment. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.